Hi, and welcome to Dollars and Making Sense, a weekly show about finance, money, and investing. I'm your host, Ray Treverson from OTG Capital. We broadcast locally on the Radio Northern Beaches and the sunny Sydney side, beachside suburbs, from Manly up to Palm Beach and inwards. And we also broadcast nationally via the Community Radio Network, compliments of the Community Broadcasting Association of Australia. We're really pleased that we've been picked up by about 14, 15 different regional stations that are out there listening to us. So thank you for picking us up and having a listen. We welcome your feedback and comments through our normal channels. I'm really pleased to welcome back to the microphone and screen for part two of a fascinating discussion around superannuation, Stuart Sheary from the Institute of Financial Professionals of Australia. Welcome back, Stuart.
Great to be back.
Now, ladies and gents, if you pick up from the last time we spoke to Stuart, we were talking about concessional caps, we were talking about non-concessional caps, we were talking about downsizing, we were talking all things superannuation. And why is because on the 1st of July, a whole bunch of stuff's going to happen and things are going to change, mostly for the good, I believe, because the rates are going up, the indexation provides for the caps going up. And Stuart, last time, just to do a bit of a quick recap on last show, we talked a lot about strategy and timing. So maybe just a quick recap. Why is that important for the listeners to pay attention?
Yeah, so last week we were talking about how there's the increase in the general transfer balance cap, which is the maximum amount that you can put into pension phase. That figure is going up from $2 million to $2.1 million. It just so happens that what we call the total super balance thresholds, which dictate how much you can contribute to super, also linked to that number. So in other words, if you've got more than what they say, the general transfer balance cap inside of super, you can't make further non-concessional contributions into super. That was basically it in a nutshell.
And we also talked about making sure those timings are staged correctly to take advantage of the indexation.
Yeah. So with the TSB increasing, there may be advantages of delaying contributions and being strategic as to when you make those contributions is right.
Right. So given that we are in a slightly higher inflationary rate than we certainly traditionally used to for the past 15, 20 years, I'm reading commentary where these caps may be going up a lot more regularly than what we've been used to in the past. And so sometimes, necessarily doing 3 years in advance may not always be the best thing. But again, none of us have crystal balls and we can't necessarily predict the future. If we could, I'd be making a fortune on those betting markets in America at the moment. But that's for another time. Anyway, let's keep moving on, because one of the things that I wanted to talk to you about, ladies and gents, we've got slides up on our blog that Stuart has prepared for his association, which he's kindly made available to us. We're talking about reversionary pensions. Now, before we get stuck into talking about them, basic question. Can you explain to the listening audience what is a reversionary pension?
Great question. So if I were to start a pension today, what I can do is nominate in the forms when I'm starting off that pension to have that pension to automatically continue to, say, my spouse in the event of my death. That's what we call a reversionary pension. So it automatically reverts to my spouse upon my death and continues. It's the same pension. It's now just being paid to my spouse. Now, compare that with an ordinary account-based pension. When I pass away, it stops. My spouse might be able to start a pension with that money, but it's not until she executes documentation to have that money recommence does that pension recommence.
Okay, that's fascinating. See, it would make sense to me, I guess, if most SMSFs are couples. Okay, so husband, wife, partner, whatever. But if you set up a pension, wouldn't it make sense to make them automatically reversionary?
In the past, yeah, it was just administratively easier to have them just automatically continue to the surviving spouse. But now there's some strategic benefits in not having a reversionary pension, because you might want to delay starting that pension until a new financial year, or you might want to start a pension for a smaller amount. So there can be strategic benefits to not having a reversionary pension.
Okay, fair enough. Now, there's some time delay. So let's say, it's always going to happen. We're all going to depart the mortal coil one day. So this couple that has set up their reversionary pensions and unfortunately one of the partners dies, how much time do they have to start doing what they need to do in regards to transferring amounts and what happens to transfer balance caps as a result?
Yeah, so let's go through it there. So if I were to pass away in the current financial year and I have a reversionary pension, then that pension, the minimum pension payments must be paid for that financial year. So if I hadn't drawn a pension in that financial year, then my wife would need to draw the minimum pension for that financial year. And there is what we call a transfer balance cap credit event. So the transfer balance cap event occurs on my death, but the value of that pension at the time of my death will count towards my wife's transfer balance cap in 12 months' time. So in other words, if she's got a pension herself, say a couple of $1 million, and then she inherits, if you want, this reversionary pension, then she's got 12 months, if you like, to deal with it, in the sense that she may otherwise exceed her transfer balance cap, because now she's got two pensions, and that additional pension, that reversionary pension, is going to count towards her transfer balance account in 12 months' time, meaning she may need to stop one of those pensions, either her own or the reversionary pension.
Is it fair to assume, let's say, for example, if both the superannuants were at the TBC, one dies, and then 12 months later that transfers back, then Div 296 would potentially start coming into play, wouldn't it?
Yeah, we've got two issues there. We've got the transfer balance cap. In 12 months' time, the survivor will have too much in pension phase, so they're going to have to commute some back. But also, as you just mentioned, the survivor now has a larger superannuation balance. So they're going to fall into Division 296 territory. And so they may actually be up for Division 296 in the financial year which they start to receive that pension, not necessarily in 12 months' time. So that's how the legislation works. So it's a little bit unkind, the legislation, in that sense.
Well, again, the cap is there for a whole range of different reasons, and given some of the excessive amounts that the superannuation scheme accumulated in the past 25 years through a whole range of different reasons, I guess having too much in your super is one of those burdens I think many of us would like to have to get a little bit greyer or balder for. Certainly I wouldn't mind that, but
keep in mind, Ray, this is where a scenario where someone was below the Division 296 cap during the financial year. They've only just fallen into that threshold because of the death of their partner, and that may have been unforeseeable, and they're going to be potentially caught in the first financial year.
But don't they have a year to make some decisions on this?
That relates to the transfer balance cap amount. So in other words, we have what we call the total super balance, which just looks at how much money you have in super entirely. So you've got an accumulation account and you've got a pension account. And so that's your total super balance, looking at all your superannuation monies. Then we have a transfer balance cap, which more or less looks at how much you've transferred into pension phase. Now, the amount that's in pension phase is too great, and that needs to be taken out within 12 months. But the total amount that the survivor has in superannuation is what we call the total super balance cap, and that looks at the values, I guess, as at 30 June of the financial year. And so with Division 296 tax, the way it's worded is it will look at your balance at the beginning of the financial year and at the end of the financial year, and unless you get that money out before 30 June, you might be up for Division 296 tax.
Okay. Well, thanks for that clarity. Let's keep moving on. We're now going to talk a little bit about indexation and proportional indexation. With the TBC increasing on 1st of July 2026, there's, I guess, questions now start coming about with regards to proportional indexation. Can you give the viewers and listeners a little bit of a potted version of what is important here to consider?
Yeah, the important thing to consider here is when we talk about the increase in the general transfer balance cap from $2 million to $2.1 million, that doesn't necessarily apply to everyone across the board. If I've already started a pension, perhaps for back in the day when that cap was $1.6 million. So I started a pension for $1.6 million when that general transfer balance cap was $1.6 million. Then I don't benefit from the fact that the general transfer balance cap is now $2.1 million. Why? Because I've used my full transfer balance cap amount. I don't have any what we call unused transfer balance cap space. And it is that unused transfer balance cap space that dictates any proportioning. So in other words, let's just say I've used half my transfer balance cap. The transfer balance cap was, say, $1.6 million at the time. I started a pension for $800,000. So an unused amount of 50%. What that legislation says is that I'll benefit from half of any subsequent increase in the general transfer balance cap. So the transfer balance cap has gone from $1.6 million all those years ago to what, $2.1 million? That's what, $500,000, meaning I can put in an additional $250,000. My personal transfer balance cap has gone from $1.6 million to an additional $250,000. Why? Because the general transfer balance cap has increased by $500,000, and I benefit from 50% of that. So yeah, that's the proportioning. That's the proportioning. That makes sense.
Fine. Okay. So again, ladies and gents, I'm going to point you back to the slides that we're going to include on the blog. So identifying the highest value, determining the used cap, as you've rightly said, proportioning that unused cap, and then again, making that contribution. Let's keep moving on. Now, practical advice, or hang on, we're just about at half time. You're here on Dollars and Making Sense, a weekly show about finance, money and investing. I'm your host, Ray Treverson. I'm really pleased to have at the microphone Stuart Sheary, who is a superannuation subject matter expert from the Institute of Financial Professionals of Australia. We're going to take a short break and we'll be back with you in just a moment. Hi, and thank you for listening to Dollars and Making Sense, a weekly radio program about finance, money and investing on Radio Northern Beaches and nationally on the Community Radio Network around Australia. The views, comments and opinions aired during our program should not be construed or viewed as financial advice. Any commentary is general advice only and does not take into account your objectives, financial situation or needs. You should consider whether the advice is suitable for you and your personal circumstances. If in doubt, you should contact an authorised licensed financial planner. We welcome questions and feedback, and you can get in touch with us via our blog, social media channels or email. Please search for Dollars and Making Sense in your favourite podcast platform or check out our blog at otgcapital.com.au/blog. Hi, and welcome back to Dollars and Making Sense, a weekly show about finance, money and investing. I'm your host, Ray Treverson. We really welcome back Stuart Sheary, subject matter expert on superannuation from the Institute of Financial Professionals of Australia. You'll note that Stuart has been on the show many times with other colleagues from IFPA, the old Taxpayers Association, an organisation that's been around for over 100 years. And you will most likely find that many tax agents out there are members of IFPA. And if you haven't seen ifpa.com.au, have a look at their website, filled with absolutely fabulous information around tax planning and finances that are absolutely worthwhile. We always give Money Smart a big plug, but I like to give IFPA a big plug because, again, this is all about education. There's no products to sell here. This is simply about hopefully arming you with good information and data so that you don't either pay too much tax or you make the most of the money that you've got. Now, in wrapping up, we've had this is part two of a two-part series that we've been talking about all the changes. Stuart, in the notes that you've provided me, we've been talking about timings and thresholds and sequencing. Can you give our listeners a real life example of when clients have got this wrong and all of a sudden it's cost them more money than it maybe should have?
Yeah, good question. So one scenario that we've raised is the downsizer contribution, for example. So we've got a client who perhaps they want to take advantage of catch-up concessional contributions. They've got a small balance inside of super. It's below $500,000, which would allow them to use their catch-up concessional contributions. They've just sold a home. They've lived in it. It qualifies for downsizer. They've owned it for 10 years. So they can make a downsizer contribution, and they just so happen they've sold this property in, say, June. And so they can potentially make that downsizer contribution in the current financial year or the subsequent financial year. Let's just say they make that big contribution into super just before 30 June. And that, as a result, that means that their total super balance is now over $500,000. And in the new financial year, let's say they had wanted to use what we call those catch-up concessional contributions. So recall, the catch-up concessional contributions allows you to use unused concessional contribution cap in the past and use those to make personal deductible contributions. Now, because they made that contribution in a little bit early, if you like, in the current financial year, they're not eligible to make those catch-up concessional contributions in that new financial year. They would have been had they delayed that contribution till the new financial year. So they've made that downsizer contribution perhaps on the 1st of July instead of before 30 June.
So I guess when you're talking to clients that have multiple strategies available to them, maybe they're downsizing, maybe they might want to make a non-concessional, or they're approaching retirement. So do you have a sequence that you then advise them to look at?
Sorry, in the context of where they're thinking about making contributions and then doing...
Yeah. So it sounds like the first thing they should be considering is the catch-ups. So that's the first thing, to make sure that, you know, we're taking advantage of the sub $500,000 limits. So that should be priority number one, then the downsizer, and then the NCCs. Does that sound about right? Yeah,
well, just keep in mind we always love our concessional contributions. They reduce our personal tax. So yes, we'd absolutely like to delay making non-concessional contributions, particularly it's around 30 June, if we're wanting to make concessional contributions in the new financial year. So yes, those sequencing would be important.
Okay. Again, given that, you know, it's not just people that are close to retirement, your organization deals with people's right across the age ranges. Are there any client profiles, particular ages or balance levels or situations where these changes can create especially significant opportunities that you think people should be aware of?
Yeah, absolutely, particularly where you've got people with higher balances, where they're impacted by the 3-year bring forward rule, or rather they're at that point. So I think it's around a little bit over around the $1.7 million mark, where we've got to start thinking about the bring forward rule and whether or not we're still eligible. So that's a key TSB to keep in mind, as well as what the earlier TSB threshold that we talked about earlier, which was $500,000, which impacts people wanting to make catch-up concessional contributions. So for people with larger balances, keep in mind that those thresholds can limit what we can do.
Okay, and again, you know, I always like to leave the show with takeaways. So are there resources that you recommend that advisors or listeners to this show should be going back to? And again, ladies and gentlemen, you may or may not be aware of, but a lot of tax agents and advisors that operate with IFPA listen to this show because it's part of their professional development. So I'm really pleased about that, because the educational content is very high. And I guess I always plug Money Smart. Okay, so it's a government website. It's provided by and run by the ATO. Tons of really good information in there. The ATO is there as well, obviously, the ATO website from a tax perspective. So Stuart, what other resources can you recommend that advisors and listeners go to?
Yeah, as you said, Money Smart, great new resources there up on their site, but you just can't beat getting personal financial advice from a trusted advisor.
Fair enough. So in closing out, looking beyond 2026, do you expect these caps will continue indexing? I mean, we've talked about the fact that we're in a higher inflation rate now than we have been traditionally for the 15, 20, and I can say 30 years prior, where we had very low interest rates for quite a long time. Do you see these index rates continuing to rise?
Absolutely, for two reasons. One reason being is that inflation is increasing, and also mathematically, the base amounts, they're getting bigger too. So generally, the increments, if you like, become more frequent when you have a larger balance. So, for example, we started the transfer balance cap at $1.6 million. When you apply inflation to $1.6 million, you don't get a huge number, but when you apply that same rate of inflation to a balance of $2 million, you get a much bigger number if you follow the math there. So yes, I would expect them to be much more frequent.
Yeah, statements of the bleeding obvious, but sometimes even those statements sometimes fly straight past people. Very topical thing to be saying at this time, I've got to say, statements of the bleeding obvious. I won't go too far further on that one. I'm interested as well. Defined benefit income caps are increasing as well. Now, a lot of our listeners will be working for government and government-like agencies and will have things like teachers' pensions, CSS pensions. What impact do these caps have on them?
Well, they're actually not directly impacted by the general transfer balance cap, meaning if you have one of these government defined benefit schemes, you're not expected to commute a pension that goes over and above these values. However, the income from those pensions, if they're greater than what we call the income cap, then they're going to be taxed higher than they would ordinarily be taxed. So the threshold is increasing to $131,250 from memory next year. If your income from any of these defined benefit schemes exceeds that threshold, then they're going to be taxed more than the one that would otherwise have been.
And again, I had this question come in actually from a listener a little while back when we talked about downsizer contribution, and I think it's well worth covering. You mentioned that contributions must be made within 90 days. So once the contracts have been signed and settlement has occurred, you've got 90 days for downsizer contributions. But what happens if someone misses that deadline? If, for example, it was a mortgagee sale or a sale because of a death in the family and it just slipped their mind, is there any flexibility there? Does the ATO look at that and go, you know what, you've got extenuating circumstances, or is it pretty hard and fast?
No, the ATO can be quite flexible, so give them a call. I think their number is 13 10 20. And if you have a reasonable excuse for why you were not able to make that downsizer contribution within 90 days, they will grant you an extension. And I do hear they're quite lenient. So well, a genuine reason.
I've got to say, I fell foul of the regulator about 14, 15 years ago. I did something wrong with my SMSF, which I only found out once I trained to become a financial planner. And when I realized I'd broken many, many rules, I self-reported. And because I self-reported, I went and spoke to the ATO. And I have to tell you, ladies and gentlemen, they were absolutely wonderful. I mean, I still copped a fine, but it was a heck of a lot less than what it probably could have been because I self-reported. And some of the errors were genuine. I got some bad advice. But Stuart, I think you're absolutely right. The ATO can be human, but I think if you try and gild the lily and pull one over them, they may get a bit nasty, I guess. And I guess, again, just quickly rounding out, for pensioners, for clients in pension phase, how do minimum pension requirements interact with these contribution strategies? A good question. Can drawing down create issues with compliance later on? Because you mentioned 4% before. They've got to draw down 4% when they first start their pension.
The biggest thing with pensions, the biggest compliance issue is not drawing enough. So you've got to meet your minimum pension requirements. So if you're below the age of 65 and you've got an account-based pension, you've got to draw at least 4% each year. If you're between 65 and I think 75, it's 5%. So we've got to draw those minimum pension drawdown amounts. Otherwise, what the ATO will say is, look, your super fund wasn't actually supporting a pension for that full financial year. You've failed the requirements, and then we've got all sorts of little problems there, such as the taxation of the super fund may be impacted. So pensions, or rather assets supporting a pension, they're tax-free. So the earnings in pension phase are tax-free. Then that can be impacted if we don't draw our minimum pension because that pension is deemed to have ceased.
And a question that's just popped into my mind, I guess, let's say, for example, right now, the TBC is set at 2 million and I decide to go into pension phase, is my TBC always going to be 2 million from then on?
Yes, because this financial year, your transfer balance cap is your general transfer balance cap is $2 million. You've used the full $2 million. So you're not going to enjoy any further indexation in the future. Why? Because you have what we call no unused percentage amount. So if the general transfer cap goes to $100 million, you're not going to enjoy any of that, versus someone who has only used a part of their general transfer balance cap, then they'll enjoy some of the indexation, but only proportionately. And someone who has never started a pension, well, of course, they'll enjoy the full increase in the general transfer balance cap.
Oh, choose wisely. Stuart, as always, a fascinating set of topics. It's topical for me. Hopefully it will be for many people that are listening today. Stuart Sherry from the Institute of Financial Professionals, thank you so kindly for being on Dollars and Making Sense.
Thanks, Ray. See you next time.
See you next time.